I'm Steve Wendling with the State Auditor's Office. I oversee the audit of the state's financial statements contained in the Annual Comprehensive Financial Report, or ACFR. The ACFR is a complex and lengthy document, coming in at 348 pages. Every year after we complete our audit, we put together a little summary of the financial highlights and trends as we see them. I would characterize fiscal year 22 as a return to normalcy in the state's finances. You can see that revenues and expenses were roughly equal, coming in at 83 billion and 81 billion, respectively. In looking at the state's revenues and expenses over the last 10 years, we can see elevated levels of both revenues and expenses in fiscal years 20 and 21 as the state dealt with the pandemic. In fiscal year 22, we saw a return to more sustainable lower levels of revenues and expenses. And looking more closely at revenues, in fiscal year 20, revenues were led by taxes, followed by operating grants and charges for services. Something interesting happened in fiscal year 21. We can see where the state's main source of revenue became operating grants and contributions, with a huge influx of federal money. Moving to fiscal year 22, we see that trend reversing with taxes as our leading source of revenue. Also noteworthy is investment income became negative as the feds began raising interest rates. Looking more closely at operating grants and contributions, we collected 30 billion in fiscal year 22. That was a reduction of 4 billion or 12% from the year before. And much of that was attributable to the federal pandemic unemployment assistance program winding down. And looking at state expenses by program area, they're led by what you might expect, and that would be human services and K-12 education as the biggest cost drivers. What's interesting, if you look at the chart, you can see unemployment compensation expenses decreased from 12 billion in fiscal year 21 all the way down to 2.4 billion in fiscal year 22. Also noteworthy is workers' compensation expenses increased from 4.5 billion in fiscal year 21 to almost 7 billion in fiscal year 22. Otherwise, most expense categories remained constant. And looking more closely at the Employment Security Department and the unemployment compensation system, we saw that the state's trust fund balance with the federal government ended the year at about 2.9 billion. That was an increase of about 44% from the 2 billion balance in the year prior. That cash balance has been increasing after the effects of the pandemic, but isn't close to where it was pre-pandemic at 5 billion. However, even at current levels, it's still one of the nation's largest unemployment state trust fund balances. We saw the unemployment rate in June of 22 drop to 3.9% from the 5.2% from the year earlier as the job market improved. Again, looking at unemployment, we can see over the 3-year period, premium revenue remained relatively constant with a bump in fiscal year 22 as people returned to work. Looking at benefit payments, we see the huge increases in both fiscal years 20 and 21, and then a return to normalcy in 22 at a level of about 2.4 billion per year. That trend follows with the federal aid for unemployment that increased in fiscal years 20 and 21, and then fell to normal levels of about 1.5 billion in fiscal year 22. In looking at state's cash with the state treasurer's office, our cash balances were healthy at the end of fiscal year 21. We can see general fund cash remaining relatively constant, coming in at about 4.5 billion at the end of fiscal year 22. In looking at other treasury cash, non-general fund, we saw a huge increase in fiscal year 22. It ended the year at over $13 billion. And that was largely due to federal money that's been received, but for which the spending requirements have not yet been met. We expect this to be spent down in 2023. And finally, the trust fund balances remained relatively constant during the 3-year period. According to Fitch Ratings Service, Washington's combined burden of debt, including pensions, is low as a percentage of personal income, but above the median for U.S. states. At the end of the year, total general obligation debt was about $21 billion, and that's up just slightly from the year prior. Looking at that debt level, we've calculated that the debt the state owes for every adult and child who resides in Washington is about $3,900, and that was about a 6% increase from the prior year. And the ratio of total debt to personal income in the state is about 5.5%. The state has a debt limit set by the state constitution, and that limits the amount the state can pay to service its debt. The calculation is made by the state treasurer's office and considers general state revenue from the previous 6 years. As of December 1st, 2022, the state treasurer estimates the limit on the amount the state can pay to service its debt is about $2 billion. And as of that date, the state was under that limit by about $605 million. The state currently enjoys good bond ratings. All 3 of the major rating services give the state of Washington its second highest bond rating. And that is important because that determines how much interest the state will pay when it borrows money. The state has a workers' compensation program, and it provides medical, time loss, disability, and pension benefits to qualifying people sustaining work-related injuries or illnesses. At the end of fiscal year 22, that program had a deficit of nearly $20 billion, and that was an increase of about $6.7 billion compared to the prior year. That worsening deficit was mainly caused by projected increasing cost claims and future cost of living adjustments. The total liability for the program was roughly $39 billion. And of that amount, $23 billion pertained only to future supplemental pension COLAs that have been promised to injured workers and their dependents who received disability payments. By law, the state cannot collect the money to fund those COLAs, and that's going to be a key part of the program's deficit, which may require increased premium revenues in the future. The state pension plans are relatively healthy. For all state pension plans, the Pew's Charitable Trust latest analysis shows Washington as having the 5th best funded ratio in the nation. The latest numbers show the funding at about 95%. The median rate for all states was only 69.5%. The state PERS 1 plan, a legacy plan that's now closed, does have an unfunded liability of about $529 million. However, that number has been consistently dropping. The state administers a post-employment benefit plan of subsidized medical, dental, life, and long-term disability insurance to those retiring employees who elect to continue coverage. It's operated as a pay-as-you-go basis, and there's no funds accumulated to pay. That current balance now is a liability of about $6.5 billion. Another unfunded liability is the risk management fund. That fund is used to pay tort claims, judgments, and settlements against the state. As of June 30, 2022, no cash or investments have been set aside for that fund, and the liability is at about $1.56 billion. The state has a rainy day fund balance. During fiscal year 21, the legislature transferred nearly the entire balance to help pay for human service related expenditures due to the pandemic. In fiscal year 22, we began to rebuild that fund. As of June 30, 2022, the balance was $335 million. However, the National Association of State Budget Officers showed that Washington had one of the smallest rainy day funds in the nation. This chart shows the rainy day fund balance over the last 10 years. Moving on to our audit results. We reported a clean or unmodified opinion for our audit of the state's financial statements. That means we believe the financial statements were fairly presented. However, we did report what we considered to be a material weakness in internal control over financial reporting. In our audit finding, we featured two state agencies, the first being the Employment Security Department. We found the department did not consistently attempt to collect overpayments of the pandemic unemployment assistance payments. We also noted the department not correctly apply accrual accounting, and some unemployment benefits were not recorded in the correct period. We noted the department was unable to reconcile its bank account, and it was overstated by about $88 million. We also noted accounts receivable and the allowance for doubtful accounts was not correctly calculated. We performed several large audit adjustments, and the balances in the summary are the remaining immaterial errors that were not corrected in the financial statements. We also reported issues at the State Board and Community Technical Colleges. They were unable to perform a timely and accurate reconciliation between the state's accounting system, AFRS, and the college financial system, CTC Link. This has been an ongoing issue as the department has implemented CTC Link, and finally at the end of fiscal year 22, that system is now being used at all colleges. We've reported this issue for the past 5 audits, and the variances you can see on the screen were the ones that have been uncorrected. And that concludes our summary. Thanks for listening.